Happy Wednesday, everyone. Welcome to another edition of #AskRobCo with James Wild. Hope you are all well. Lots of good updates this week with deal flow and sales and transactions and some really good intel, data and trends that we're going to be bringing you like we do every week. Last week, we had a great update from our friends at Lonres, Marcus Dixon. It was a really great show and really great information that they provided. If you missed that, if you don't have the data, if you don't have the intel that Lonres provided us last week, please reach out to me and I will share it with you and your teams. It was just such great information. How are you, James? How has your week been?
Yeah, really good. Thanks, Rob. It's been a busy week. I sort of get the feeling that there's a bit of momentum brewing in the market. I mean, certainly we've been busy on everything from transactions through to refinances, through to some exit loans and development valuations. So across the board, a flow of activity and very busy.
Yeah. Okay, we've got some great updates this week. So lots of handouts on the right-hand side for you all today. Our generic weekly update with our sales intel, followed by the UK residential property transactions that were released last week. And then we're doing a bit of a historic review of those March transactions and looking at the last 15 years residential trends. So really, some really good data. So let's fly through that. And again, anyone that's listening audio only and wants all of that sent, please do reach out. It's really, really good stuff we're sharing with you today. So let's go handout one and go straight into the numbers for this week. What we've got is a continuing trend of what we would say are low sales volumes in context of what we've seen over the last 6 to 9 months. So this week we are at your sold column 129. It's a low number, especially when we're so used to being in the 200s. And remember, this data and information we're giving you is live. So all of this is based on the exchanged properties that have gone through in that period of time. Whereas the information we're going to give you on the next handouts is the completed transactions, where there's a lag because that information takes a bit longer to come through. Those deals would have traded in the back end of last year or early part of this year. So there's the live information we're giving you now of what's actually happening on a daily basis in our marketplace and across the UK. And then there's the time lag information. I think it's really important to understand the context of that. So our sold numbers are down, low 100s, low figures. Our new instructions are consistently in the mid to late 300s, but nowhere near the 500, 600, 700s that we were seeing at the back end of last year. And I think that's a real important point of where the market is at the moment. I've been speaking to all the agents this week, asking them what's going on, what are their stock levels like, how are they trading, and the feedback is very, very clear from the agents. They are suffering from a supply stock shortage. They've got plenty of buyers in the market. Everything that comes to market is selling, but there is a shortage of stock, which is in terms of this data, new instructions, not enough stocks coming on stream. Thus, it will be interesting to see how those sold figures play out over the next month or two, because what we're being told, the data that we're sharing with you here, and what the agents are sharing with us, is they just don't have enough stock. James, what are your viewpoints on this?
Yeah, just to add further, Rob. Obviously, we commented on this, and that there was quite a lag and a delay from the government in extending that stamp duty holiday. So I think the market is still adapting to that, and obviously the sort of intersections of the momentum coming back in, the transactions aren't able to progress fast enough for this data to remain at the sold figures we've seen, which were consistently around the 200 mark. I think the new stock levels, the instruction levels, are nearly half of what we saw at the end of Q4 2020. So this is obviously holding back the transactions. Buyers have less stock to purchase. And I know across London, we've seen historically that when there has been stock shortages, this has somewhat fueled the market. So it's going to be interesting over the coming months, as the market is reopening, what impact some of these stock shortages may have on pricing. And this may be very specific on certain localized markets or property types. But certainly we'll have to monitor how those stock shortages fuel the market and what are the knock-on effects.
Brilliant. Let's move straight on to handout number 2, which is the UK residential property transactions month by month. This is March 2020 to March 2021. Well done for the research team for getting this one out. This is a brilliant one for us to discuss, and I'm loving this data. I like to focus more on the non-seasonally adjusted than the seasonally adjusted. So everyone viewing handout 2 now, we're going to focus on the green line, the non-seasonally adjusted figures. So I just want to take you back on a journey over the last 12 to 14 months. The election happens in December 2019. January, February 2020, really good months. We have nice volume around the 180 to 100,000 figure. Pre that, we traded at about 80,000 volume-wise for residential UK transactions for quite a few years. Very, very flat. Brexit, stamp duty, and so on. It was just very flat market, 16, 17, 18, 19. The election happened. We had a lovely bounce in January, February. Then COVID hits. And if you look at the chart now, that's the decline from March 2020. Then April 2020, it goes right down to below 40,000, which was a real impact month. And then slowly but surely, month by month by month by month, you see that absolute growth throughout the whole year, to which when we reached December, we were over 100,000 as we predicted back in September, October 2020. There was a slight dip at the beginning of this year, just because everything shut down over Christmas and New Year. And now suddenly, March 2021 and February, 140, 180,000 transactions in the UK in the residential market, 16-year high, near 2-year decade high volume of transactions. Shows the wave and the momentum and the sentiment in the market of what we've seen. And I think this chart is so powerful. Everyone that's in the industry, especially exposed to residential, is seeing unprecedented volume. And now my question is going to be, James, you know where I'm going with this. It's what we've been asking the last few weeks. That the data for this shows that March had the record volume of transactions, 180,000. We know that most of those deals were put together in October, November, December of last year. A lot of those deals were working towards the stamp duty pre-budget deadline. And so my question to you is, 180,000 surely is not sustainable at those numbers, and it's now going to drop back down to 140, 120 and find a new level, because those numbers are just off the scale. You're talking about trading at double the volume that we would have traded at for the last 4 or 5 years, and I'm not convinced that those numbers are going to be sustainable at the 180,000 figure. So what are your views on that, and any other nuances from this chart that you want to talk through, James?
Yeah, thank you, Rob. So we obviously had the announcement of the stamp duty holiday in July 2020. which we've had sort of that 9-month period. Everyone was working towards the March 2021 deadline, which I think is obviously reflective of the data here. That is the current peak we've got. There was obviously the delay in the announcement from the government of the extension of this. So as expected, we will see, and we are seeing in some of our live data, a slight drop off on the sales volumes. This could, I am anticipating a further surge prior to the end of June deadline for the stamp duty, which is under the same provisions as it's been since July 20. I don't think we're going to reach the peaks of March 2021, as the market had 9 months to really build up to this. Since the government's budget announcement, we've only got a few months, and we're not going to see the same momentum. Those were initially sort of moving as a result of the stamp duty savings and sort of partial holiday. I think a lot of those early movers, the impetus has been taken from those, but there is obviously going to be a second wave with this stamp duty extension, and whether we'll get up to the sort of 140 to 160 mark, I think that's more realistic. We're going to see a slight dip and then an uptick come the end of May and in June. That is my prediction based on these graphs and the data we've got.
Thanks, James. Let's move swiftly on to handout number 3, which is the like-for-like historic March transactions. Everyone that knows me and understands that, I'm 28 years in the industry. I love context and a macro historic outlook on market conditions so that you can actually really give a really good micro perspective of what's going on now. So I love this, and again, well done research for pulling this one out. Handout number 3. This is the March transactions year on year over the last near on decade. And so first and foremost, I want to compare March 2021, the non-seasonally adjusted. I want to stick with that, the 180,000 we've just been talking about. Let's compare it to March 16. Anyone that was working in March 16 will remember that was the month where the capital gains changed. All the transactions had to get through by that month. You saw an absolute one-off surge, to which many people will say that was one of the biggest surges in a 1-month period that they've ever seen in the industry. And that was 171,000 purely on that month, compared to the 180 where we've just gone through. So I think that within itself shows what an incredible month March 2021 was. At the same time, the context of the last decade, March 2012, 86,000, 13, 79,000, 14, 91,000, 15, 91,000, 17, 105,000, 18, 95,000, 19, 95,000, and 2020, 86,000. Every year, broadly between 85 and 95,000 consistently for a 10-year period, to which this year we've seen double the volume. I think it's incredible and unprecedented outside of that special March 2016 position. And I think putting a 10-year perspective on what we're seeing at the moment provides real context. James, anything else you want to add on that?
Yeah, what I would add on that is obviously what we're seeing, the current stamp duty holiday has had a greater impact on the market than the March 16 changes, which saw the 3% surcharge being brought in for second home or second property buyers. And I think that the current situation with the holiday on the first 500,000 obviously appeals to a wider market than the 3% surcharge. So I would have expected this current stamp duty incentive by the government to have a greater impact on the market. But as you can see from this 10-year historic data, it's eclipsed any of the March figures we've seen for the last 10 years.
Brilliant. Last graphic and data for today. If everyone can go to handout number 4, historic residential transactions, just to have even more context over the last 16 years. And again, let's go with the red non-season. Well, red is seasonally adjusted now, and green is non-seasonally. Let's go with the red lines here, because I just want people to understand the March 16 position or what happened, the context around that day, and then understand the position we're in now in 2021. And the market has been so flat in terms of residential property transactions for the last 5 years, 15 to 20. And even the years before that, the volume was very low. The last time we saw anywhere near the kind of volume of transaction we're seeing now was back in 06, 07, just before the Lehman's crash. And I just want to re-emphasize the fact that the current volume of transaction levels are once in a 15, 20 year scenario, to which is very much unprecedented, and it's a testament to either the economy, the stimulus, the robustness, or the cheap debt, or a combination of all of them. And the big risk, sanction, credit, sales question we've all got is, how sustainable is this? What is this now going to look like in Q1 2022, knowing that a lot of the stimulus out there at the moment is going to drag us through 2021 in a positive way? Anything else on this one, James?
Yeah, thanks, Rob. As you can see from this graphical table here, of the last 15 years, we can see that there's been some anomalies in March 16 and also now March 2021. Now, these have obviously brought on by the government incentives of stamp duty, and I think this would have been something which they have maybe been sort of forced into to try and assist the economy, as sort of the housing market is something they want to keep very sort of steady, slow and steady. They don't want it turning into a market similar to what we see in financial markets or foreign exchange or those commodity markets, where they are more volatile. They want more steady growth. So it's how this will affect the market moving forward, and whether we will go back to a more steady period of growth. But it is interesting how the effects of stamp duty do obviously sort of slow the market somewhat in terms of holding periods, and how these savings obviously bring buyers to the market to cash in on these savings, which are obviously short-term incentives by the government on stamp duty.
Great, James. Great intel today. Great data. I love that context. Last 10 minutes, let's move over to a bit more economic, retail, commercial, and other announcements that we've seen over the last week. I'd like to start with the City of London conversion of 1,500 new residential units from office to resi. Thoughts on that, James, and anything else you want to add in that area?
Yeah, no, thank you, Rob. So the City of London Corporation has announced this initiative. Their plans, like you say, 1,500 new homes. The sort of time periods for this in the next 9 years to achieve this by 2030. We have seen sort of similar models to this work in the past in terms of conversion to areas of non-residential use to residential use. We've seen parts of Victoria, which was previously a very core office location. A real swathe of new build flats which have been built there in the last 5 to 10 years. I know land securities have been very active there. We've seen places like Battersea Power Station, previously an industrial site which has changed to residential-led master plan. Here in West London, we've seen the television centre at White City be converted from obviously the BBC's former offices to 400 flats now, which have been a great success. It also includes Soho House, restaurants and partial office space. So it is a model we've seen work in the past across London, which obviously has been good to regenerate areas, to enable them to continue as established residential mixed-use office areas. So I think it would be quite groundbreaking still, as obviously the Golden Mile in the city has been so iconic as solely office use. Well, since forever, really. So whether the type of units we'll see there, it could be a lot of pied-à-terre flats, those which are working in the city to maybe suit that flexible working, maybe a sort of partial week in the office. I wouldn't anticipate them being people's sort of many people's main residence, just because of the sort of access to like local parks there and amenities. So I would expect it to be quite a pied-à-terre market, possibly young professionals and those working in the city, but we'll move to create a more sort of vibrant and mixed use area.
Great, thanks for that. Let's move over to retail and the high street. Office of National Statistics released their latest data showing 5.4% increase in retail sales across all areas, which is over a 5-year period, a peak when you take out 2020 of the beginning of the end of the lockdowns. And so that's really, really positive. And actually, when you go into clothing, those increases are at 17.5%. And I think there's a real buoyancy now as we end the restrictions and the lockdowns, and the markets are a few weeks away now from being fully open in terms of pure retail in all aspects, including hospitality. There's a real buoyancy around the spend of that excess cash that has been saved by many during the lockdowns to hit the high streets and retail spending. I think the first figures that have just come through are really positive in that sense.
Yeah, no, thank you, Rob. I mean, the queues for Primark have since slowed and maybe shortened slightly, but we do expect a continued demand for the retail sectors. And like you say, those which have maybe sort of saved some money over the last 12 months to spend that on the retail sector, the leisure sector, and also maybe the sort of domestic holiday sector as well, coming into spring, summer.
Brilliant. Last 5 minutes, any other business or news for us this week, James?
Yeah, in terms of the property market, the residential sector, it's been quite an active week. Again, we've spoken about some of the low levels of new instructions, but we know that US-owned estate agency Berkshire Hathaway have made further moves into the London markets with their takeover of the Knightsbridge agent Marler & Marler. So that continues their expansion. Obviously, Berkshire Hathaway is a US-based company owned by Warren Buffett. Beecham Estates are opening a shopfront office on St John's Wood High Street. They're continuing their expansion with that estate agency having further plans to move into Europe and the America, Gulf states and Asia. So they're continuing their expansion, obviously very well known super prime London agent. So just in terms of the agency sectors there, we have obviously seen a flurry of activity in the last week. So whether that's signs which they believe that the market is improving, we're coming into a period with good momentum, better sentiment, and I think ultimately with these investments and commitments that some of the market leaders are making, they're obviously anticipating a strong second half to 2021.
Brilliant. Thanks for that, James. Anything else you want to know in relation to deal flow, pricing, credit, risk, loan to values, valuations, affordability, sanction, data, historic trends, commercial, residential? We are here for you every week, 1 p.m. on a Wednesday, and across all the platforms. And if you can't see it live, you can watch us on YouTube afterwards. That's all for me this week, James. Anything else you want to add before we leave?
That's it. There was just some news that Stoke Park Golf Club had been acquired by the Indian businessman for £57 million. Just a bit of sort of background property news for anyone that's interested there as well.
Yeah, all the golfers MJ Group are happy and out there, and they're back out on the courses and working on their handicaps and enjoying the freedom of returning to normal life. I don't know, have you been out at all, James?
I've played a couple of times. I've never played at Stoke Park, actually, but I know that it is quite a famous golf club for having appeared in James Bond, I believe in the Goldfinger film, so one that's well known throughout England.
Yeah, I'm still focused on the football, and I think I'm about 15 matches in now, literally 3 games a week for the last 4 or 5 weeks. So I'm enjoying that. Brilliant. Thanks, everyone. Have a great bank holiday. Keep supporting us on all the platforms, and super grateful for everyone that's here week in, week out, whether live or not live. Keep asking the questions, keep turning up, and we will keep giving you everything you're looking for. Have a great week. Have a great bank holiday, and thanks for joining. Take care, everyone. Thanks, James.